Okay, this is the paper. Very simple introduction. Everyone knows what this is. The rate of return on the equity investment. Okay, required rate of return. Importance, it's essentially an exogenous variable in several of these fair value models. Either you directly estimate a firm's equity or you estimate using the weighted average cost of capital as the discount rate, in which the cost of equity is going to be an input and generate, evaluate, discount the cash flows of any cash flow generating asset in general, funded partly by equity and partly by debt. So I'm going to quickly move through this stuff. One of the problems I found in the literature review, there does not seem to be a satisfactory taxonomy of cost of equity estimation models. Okay, so I'm very obsessed with taxonomy whenever I go into any field. So there is some element of that, but even Damodaran's classification is this is not really a taxonomy of cost of equity estimation models. This one is, but this is not a proper classification. Here's the classification he has done. The problem with this is, violates a basic rule of taxonomy, which is that your taxa have to be mutually exclusive. APT is actually a class, it's a species of multi-factor model. Proxy models like the Fama-French three-factor model is also a species of multi-factor model, so you can't put these outside. It's like saying Indians, Biharis, Bengalis, you can't do that. Biharis and Bengalis have to go into the Indian category. So this is a wrong classification. It's actually an incomplete classification as well, because he leaves out one important category, which is the implied equity risk premium way of estimating the cost of equity, which is also a risk return model. All the cost of equity estimation models are risk return models. Okay. So here's what I think is the proper taxonomy. I've left out one method which is very frequently used, which is the bond yield plus the risk premium method. I've not used that, but this is the the commonly used methods. This is the proper taxonomy according to me. Single factor models, most famous of which is the CFDM. Nowadays you have in the industry a lot of elements of smart beta, lots of funds based on smart beta. These are also single factor models actually, but the CFDM is the most famous. Multi-factor models, arbitrage pricing theory, other variations of arbitrage pricing theory, which specify the risk factors, and the Fama-French also goes into this area. And the third is the implied cost of equity approach to estimating the cost of equity. So this, I think, is the proper taxonomy. Okay, and these two are not included in normal discussions of the cost of equity. You might find reference to these two as well, the historical approach and the survey approach. But these are actually sub-problems within the implementation of the CFAM framework. So these are not directly, approaches to estimating the.
Can I just interrupt for a second, Ram? You have to do it a little fast because we have to start the program. Otherwise, I cannot take the delegates on the.
So
we have to go to mail.
Okay, so these are not included in the taxonomy because these are sub-problems within the CAPM model, within the implementation, so therefore they are not properly included in the taxonomy. We will discuss this a little later. Some important features of the cost of equity which are not normally alluded to, okay, which is that we have to understand that the cost of equity estimation models are trying to actually pin down what is a normative question. What ought to be the correct value for the cost of equity, or how ought we to correctly estimate, what is the method by which we should estimate the cost of equity. So it's really a normative question, what should be. And as far the problem with that obviously is that when you're talking about a normative variable, you actually cannot ever observe it in practice. Okay, you can't actually see. It's not like temperature. If I want to derive a model for estimating the temperature in Delhi tomorrow, now that is something which I can observe. Here the endogenous variable is the cost of equity, and that is not something that can be properly observed anywhere, ever. Whereas if I have a model for forecasting temperature in Delhi, there the endogenous variable is something that can be observed at least on an ex-post basis. Okay, so there's something that has to be understood here. And therefore, normally what we do with the common way to evaluate predictive models is, suppose I have a temperature forecasting model, I will make a forecast for the temperature in Delhi tomorrow, and suppose it's 32 Celsius and the actual temperature turns out to be 29 Celsius. So you'll see the deviation between the forecast and the actual. You can observe the endogenous variable, and that's how you would say that this is a bad predictive model or a good predictive model. Now that's a normal way to do it in scientific approaches, but here the point to understand is that you can't really evaluate cost of equity estimation models in that manner, because the cost of equity itself cannot be observed ever. Okay, so therefore you need some other. So this is an ex post kind of approach to evaluating the effectiveness of predictive models, which we do in science. Okay, but what you have to do in the case of the cost of equity estimation models is you have to adopt an ex ante approach, and it has to be based on something other than the other than this approach. You can't apply this approach because you can't observe the endogenous variable. So you have to basically follow. So here we just have this reference to Friedman, the famous article, Methodology of Positive Economics. Friedman says that a theory should be evaluated based on the accuracy of its predictions and not on the realism of its assumptions. But again, this you can't do in the cost of equity estimation models case, because you can't even evaluate the accuracy of the predictions. If you had a model for predicting the unemployment rate 2 years from now, that you could evaluate based on the accuracy of its predictions, because you can observe the unemployment rate. The cost of equity as a normative figure can never be observed, and this is not something that is normally highlighted in the literature. Okay, so we have to fall back on other criteria to evaluate the quality of cost of equity estimation models, such as the conceptual soundness, realism of assumptions, etc. Okay. So brief literature, we can just scan this. So normally you see two trends in the literature review. One is the initial phase where you saw the development of the models, the cost of equity estimation.
You can skip literature review.
I'm skipping it. I'm going to skip fast. Okay. So just two phases: initially development of the theory, here the CAPM, and then the other approaches. And then you see another phase, the later phase. There's not much work being done on the theory development. It's mostly the empirical estimation, okay, which is on how you apply the theory and the empirical estimation questions that arise in the context of the applications of the theory. That's the trend in the literature. Now quickly evaluating the models, single factor models, CAPM, and I'm going to go through these models one by one. So CAPM, obviously most widely used. Notice it has three exogenous variables. These are the three exogenous variables, okay. Now actually this is supposed to be called an equity risk premium, but if you look at the theory itself, this is meant to actually be the risk premium for the entire risky asset portfolio, including everything, okay, including human capital and everything, but in practice it has kind of defaulted to the equity risk premium. Alright, so these are the two approaches that are normally used to estimate. The historical approach and the survey method. Okay, so I'll just give you an idea of the historical approach. Normally what we do is we just try to estimate how much have equities outperformed relative to bonds. So something like this is done. You take a time period. This is from about 1926, and then let's say you say average equities have returned 11% and government bonds are 5.6%. Okay, and then you take the difference between the two, and then you say this is the historical equity risk premium. So therefore, this should be the risk premium in your CAPM model. This should be the exogenous variable in your CAPM model. The problem with this approach is, the problem with this is that you're actually again taking a positive approach to solving a normative question in the first place, because the CAPM, the cost of equity is as an endogenous variable, what should be the cost of equity, and you're looking at what has been in the past and you're using it as an answer to a normative question. Okay, so just because basically the problem here is, if you go back to this chart, just because equities have outperformed over this historical period, and then again the outperformance will change if you change the period. Okay, if you change the period, the outperformance numbers will change. Just because they have outperformed by, let's say, about 6% or 5.5%, that does not mean that 5.5% is the theoretically correct value for the equity risk premium when you're looking forward. Okay, this does not logically follow. Just because something has historically happened. Okay, and first of all, you can't even observe. This is just an ex post relationship. So here, basically, this is the logical problem in the way that this CAPM has been applied. Okay. So essentially, what you have, again, the survey method is essentially the same thing, a slightly different approach. The survey method, what they're doing is they're surveying by industry practitioners, corporate finance managers, etc., and trying to ask them, what do you use as the value for the equity risk premium? What have you been using? And you take the median value that is coming out of the survey, and you take that as your equity risk premium going forward. Okay, again, that has the same problem, that just because all these practitioners could be wrong. Okay, so just because people are using a certain value for the equity risk premium, in practice, that doesn't mean that it's actually correct, theoretically correct. Okay, what should be the value going forward? Here, essentially, the problem partly with, especially the first approach, the historical approach, is that the risk-return relationship, which is proportional, that higher risk you expect higher returns, that is only something that has to exist in an ex-ante setting. It need not exist in an ex-post setting. So a high-risk investment can actually earn a very low return. So ex-post, that relationship need not hold. So the historical approach has these kinds of conceptual problems. Okay, so but however, the most important failing of the CAPM, once again, not at all highlighted much in the literature, very little, that you can't have, I mean, it's a very poor model design to have an exogenous variable that is not observable. Okay, so what I'm talking about is good model design is if I'm trying to predict students' end-term scores as a function of their midterm scores. Here the midterm score is an exogenous variable, but the midterm score is observable. Okay, so I can take it, observe it, put it into the model. But here you have an exogenous variable that is so bizarrely defined that it's not even observable. Okay, so this is very poor model design according to me. So, and this is why you get all these other problems. That's why you're working with, working in all these other convoluted ways to try and implement this model. So this is the problem. This exogenous variable is not observable. Who is the marginal investor? Whose expected return is to be taken? These are all very fuzzy problems. And why do we have this problem? There's a general problem in corporate finance that there is this casual reliance on expected return. It's like God or something like that. God will solve the problem. And this has come from the Markowitz mean variance model, which started it all. Basically, the CAPM derives from the Markowitz mean variance framework. And there too, if you look at it, theoretical finance has always approached this problem from the perspective that there are certain expected returns and variances of returns which will prevail in the future, which we know. And based on these expected returns, we are going to design the portfolio. But in real life, that doesn't happen at all. You can't even forecast one day ahead. So it's absolutely, this is a totally unrealistic approach, and the reason the CAPM has this problem because Markowitz started the whole problem with his expected mean variance. This is all expected mean variance ex-ante. The models are all designed on an ex-ante basis. Okay, they are meant to be implemented on an ex-ante basis, but in fact what is happening is we are taking ex-post realized values from the past and then implementing them into a model which is supposed to really be looking at ex-ante. So God is supposed to tell you these future mean variance figures, but God is not there. So anyway, so this is the problem. In practice, you can't implement this, and this is basically why you have problem all through. In the Markowitz problem, in the Markowitz portfolio construction problem, in the CAPM, also in the APT, the same problem will persist in the APT as well. Okay, so even Keynes, this is a problem in theoretical finance and economics. Even Maynard Keynes, the only economist, the only academic economist to have actually successfully managed a equity fund. He's a very successful fund manager for a couple of Oxford colleges. But even he, when he defines contact-mode backwardation in commodity markets, he uses this concept of expected return. According to me, this concept should be banned from theoretical finance. The most asinine concept I've ever heard of, but it should be banned from theoretical finance. Okay? Alright, so individual asset beta estimation is also another problem where you have a problem of periods and things like that, but we won't talk about this, yes?
Can you compare results?
Yeah, there are results of the, I'm just coming to, this is a critique, one sec. Another problem with arbitrage pricing theory, same problem. This assumes that people are going to perform arbitrage based on expected returns, okay, in the future. But in fact, once again, you can't be sure about the expected returns. So therefore, this is not really arbitrage. Okay. So in real life, what happens is because expected returns in the future are just estimates, they need not come true. In real life, no arbitrator operates like this. Real life arbitrage works where you have simultaneously you can observe two assets, same asset in two different markets, mispriced relative to each other, and you buy one and you sell the other. That's how real life arbitrage works. So this guy has actually assumed the operation of real life arbitrage based on expected returns, and he just assumed that everybody knows the expected returns, and there is a variation in expected returns leading to arbitrage. So that's the basis of this theory. So there are two variations of this theory, one with specified macro risk factors, one without specified macro risk factors, but I'm not discussing any of those further. Same problem everywhere. This model has fewer problems. Is the 10 minutes time already over?
Yeah, so I'm looking forward to getting your results. Actually, when
Yeah.
you can treat what
I'll tell you what I mean. I'll tell you what I mean by results. I'll come to that. Okay. So Pharma French is the least problematic of all the models. Okay. The only problem essentially it has is that which applies to any regression structure, regression type forecasting model in financial markets and in economies is the problem of non-stationarity. Okay. So essentially this is the specification of the model. Three endogenous variables. Okay. Value, trying to estimate the value stock premium and the small cap stock premium. So the same problem is the problem of non-stationarity, which although you found that your data is stationary, but in fact the long-term data sets, if you look at really long-term data sets in financial markets, you will find that there is always non-stationarity. This is one of the problems why no predictive model really works. If you look at this, here I've given you a chart, a long-term chart of crude oil prices. If you go back, if we can get this here. So you see almost a 20-year period. Essentially what non-stationarity means from a visual point of view.
not deviate, understand.
Okay.
Because otherwise there will be controversy, because we haven't read the literature.
Okay. So non-stationarity is the problem in the Pharma French problem because your regression coefficient estimated from past data need not apply to the future. Okay, again, these are all meant to be ex-ante models. And again, as the point that Sanjay Kumar raised, correlation does not imply causality. Okay, here these are meant to be these causality-based models. The exogenous variables are essentially meant to be causal factors. Okay, implied cost of equity approach is the third other approach. I don't think we have even time to discuss that, but I'll just briefly give you an idea of what is involved here. What they're trying to do in implied cost of equity is they are making an assumption that the fair value of the stock, the market price is equal to the fair value of the stock. That's what they're assuming. Okay. So as you know, the fair value of the stock is like this. You discount the future earnings. Okay. At the discount, this is the cost of equity, and this is the fair value, IV, intrinsic value, fair value. And you assume that you replace the IV with the market price. Okay. So the market price is known. You take the consensus analyst forecasts of earnings for these values. And then, of course, this is one equation and one unknown, and you can iteratively approximate and solve it like IRR, okay, or YTM. So this is the way you solve it. But the problem with this approach, obviously, is that you are making this huge assumption that the fair value of the stock, based on these earnings estimates, is equal to the market price of the stock, which means you are saying that the market is informationally efficient, and in particular, it is semi-strong form efficient, if you want to use the EMH parlance, which is a hugely problematic assumption. Okay, need not be true at all. There are other problems in terms of assumptions with this model. Okay, so right. Okay, questions. I guess I should finish up now.
Which model is good? Which model?
Okay, let me just come to the last part. This is the last part. So coming to Sanjay's question about what am I recommending. Some of the critiques that I've done. So what I propose to do is suggest a better estimation model. Now these should be, what I'm trying to do is cut out the properties of an ideal model. Should not have exogenous variables that are not observable. Okay? Should not have too many exogenous variables, because if you have too many exogenous variables, you have out of sample robustness problems when you go into out of sample testing. Okay, you estimate your regression parameters from some sample data. When you go on, if you have too many exogenous variables, when you go out of sample, you have robustness problems. Okay, then should not make aggressive assumptions about behavior, market efficiency. Occam's razor principle from philosophy, as simple as possible. A lot of the models are very complex, so the model should be as crude and simple as possible. Okay, then should be logically, conceptually sound. You should not be, I'm not sure it here, but the CAPM according to me is susceptible to a reductio ad absurdum critique, where you can shake the model, take the model assumptions, apply logic, and show that it leads to ridiculous conclusions. Okay, so that's a reductio ad absurdum critique that should not be applicable to the model. It should be intuitive, realistic assumptions, etc. So these are actually my findings. Essentially, I have tried to look at the flaws of the existing models, and I have set up what the ideal model should have in terms of its properties. Okay, now questions. Okay.
I don't have questions, I have comments.
Okay.
First, the models which you discussed here,
Yeah.
in practice, the most popular is this CAP.
Yeah.
Nobody uses survey method, it's like a decision what we use it,
Yeah.
and they're doing it.
Yeah.
Even the implied cost of equity is not, no one, I haven't seen any company using it. But I have seen several companies using capital assets.
Yeah. CFA is most common. Yeah.
Second thing, that you talked about theory, I think this is a model.
I talked about which one?
Capital asset pricing
Yeah,
is
yes,
a model, it's
yeah.
not a theory.
Yeah.
There is-
Theory. Okay. Yeah.
There is a difference between axioms, theory, model. Okay, so all of us understand axioms are accepted truths or they are the theories which need not to be validated. They are validated. Of course. But, and as far as theory is concerned, that you develop a theory through a process of abstraction actually, and then the validity of theory depends on its empirical validity. As far as CAPM is concerned, there have been controversial articles, but majority of the articles have proved that by and large CAPM works. By and large. So there are significant deviations, but then it happens, particularly in developed capital markets, even in India, people have been proving that CAPM does work under many conditions. Then another one is about your model is the it's a purposeful representation of a reality. So what is the reality? Reality is that there is a difference between debt and there is a difference between equity. The equity shareholders assume more risk. The question was that how do you measure that risk? It could be done subjectively, your assessment, my assessment, our assessment. And that is how you could do. If I may say that if the fixed deposit in bank gives me 8%, if I am putting my money in your debenture, the company bonds or debenture, I should get 13%. That is subjective. Then, so what is the objective way? So this model at least prescribes. Now, the way this model was developed was through a process of abstraction. When you're talking about Markowitz, for example, he made a lot of assumption of course. And the entire, it is not only you, the entire literature criticizes CAPM, but in spite of that, they say, oh, we don't have any other method, therefore CAPM approximates your risk. That is one thing. So then you can't throw it out of windows unless you find a better method.
Yeah.
That is what the rules are as far as the practical application is
Yeah.
concerned. So we agree with your criticism. That is also a criticism of many people. Arbitrage has more limitation than even CAPM. When you are talking that arbitrage model, or they call it theory, would work better than CAPM, actually there you have multiple betas actually.
Yeah.
Here there is one single beta, market-related risk.
Yeah.
But then for everything, and what is that everything nobody knows? It could be GDP.
Yeah, because Ross's APT does not even specify the macro factors.
So it's more
Yeah.
complicated, more unacceptable than
Yeah.
the
Yeah, I have said that is my slant also.
That
That
is-
it's even more problematic than Markowitz
Okay.
and the CFA.
If you look at differently, if you don't want to get into CAPM, then you say where from the risk arises. There are two kinds of risk, as all of us know. It's the operating risk, which comes from your variability in sales, it comes from your cost structure, and then there is financial risk, which comes from your leverage.
Leverage, yeah.
So the debt. Now, there you have data actually. If you really want to compare to the CAPM, that's a check. That you can go via that route where you are not using the market price of the share. And you can determine, you can get an account. Because ultimately the manager needs some number, some number. If you have problem with that, even cost of capital, so you do calculate it. But as far as your projects or investments are concerned, you calculate internal rate of return. You are calculating today, you can observe tomorrow. So that is your problem. And then based on your subjective judgment, and even that wrongly calculated the cost of capital, you can really compare it. So what's the problem?
No, but internal rate of return, you still need a hurdle rate as a reference. Because if I see a project with a 13% IRR, is that good for me or bad for me?
That's what I'm
That
saying.
depends on my hurdle rate.
That's what I'm saying. That
Yeah.
is hurdle rate is a problem. No, you're saying
That for that I have to come out with a WACC,
back. You come
and
with
for
the-
that I need a cost of equity.
If you don't have WACC, if you don't have CAPM, at why you subject to judgment? What's your problem?
No, but
People are
subject-
good.
No, but historically,
You don't have time for another question, unless you have something. You want to ask? Okay, quite quick, yeah.
Give him the mic. I don't think it's because there's a lot of noise. I can't hear him.
Now, by the way, have you read about bottom of beta
Bottom of beta.
and consumption beta? There are
Oh,
many-
bottom up beaters, yeah. Bottom up beaters, I know, yeah. Because I don't think that is. I mean, I'm not happy with the whole structure of the CAPM. This beta-based approach. I don't think that is the right approach.
But then, what is available?
What is the
That is
alternative? Yeah, I'm looking at alternatives.
best.
Yeah. So I'm looking at alternatives. Yes.
One of the objections that you are actually raising.
Yeah.
All these objections.
Guys, get a little bit quiet over there. I can't hear what he's saying.
See, all these objections that you are actually raising, these all come probably because you believe that finance might be something like science, okay, where if I say force is equal to mass into acceleration, okay, but finance is actually not science, okay, as sir has already said that it is just theory, okay, finance is actually one of the subsets of social finance, where we may not have something like force is equal to mass into acceleration. So all your objections actually arise from expecting finance to be like science, what it is actually not.
No, but actually, if you look at if you make this kind of statement in an academic finance department, they will cut you into pieces because in an academic finance department.
Thank you. I now request Dr. Pandey